Today we are discussing the tax implications of dividing assets in divorce. Now, a lot of people don't realize this, but the end of a marriage is a tax event. Why? Because generally speaking, when people split up, they need to transfer assets from one to the other. And today we've got a variety of different assets, and the federal government, which controls the taxation of assets in Canada, applies different tax treatment to different assets. So, by way of example, a matrimonial home is treated differently than the transfer of an investment property, which is treated differently than the transfer or the division of a pension or an RSP. And of course, bank accounts and so forth. So each one of these has a different tax treatment. Now, in some cases, it's a lot easier to say it this way. A matrimonial home, generally speaking, if it's your principal residence, there are no tax implications. But a lot of people don't know this. You can have multiple matrimonial homes, which mean you get the protection of the right to the property under Ontario family law. But the government of Canada only allows you to declare one home as your principal residence for the purposes of avoiding the tax on the gain that you made. It's a bit of a twist, and a lot of people don't know that. But then, separate and apart, there are tax implications for, of course, collapsing an RSP. There are tax implications for liquidating an investment portfolio. And so, fortunately, the federal government, in their wisdom, recognized that it's not fair for couples who are splitting up to have tax hits when they split up. So they created a bunch of exceptions. So they, for example, provided in the Income Tax Act that if you are transferring money out of an RSP to your ex-spouse as a result of divorce, so long as it's in a separation agreement and it's properly papered, then there would be no taxes paid. But in some cases, people actually dip into their RRSPs in order to settle their divorce case, in which case there is tax to be paid. And in that situation, in some cases, there are adjustments made to the calculation. But bringing it right back to the very beginning, this is the nice thing about we family law lawyers. We got to know a lot about a lot of different topics. And one of them is giving clients advice when it comes to the tax implications of divorce. And a lot of people don't realize how important that is. And to use a small example, when someone says to me, why don't I just pay my ex a lump sum of spousal support, which is another tax implication, because under Ontario and Canadian law, if you pay spousal support monthly or weekly or biweekly, and it's in a separation agreement or court order, it's tax deductible to the person paying and it's taxable to the person receiving. But if they go ahead and convert that into a lump sum, it's tax-free to the recipient, and the payer doesn't get to deduct it against their income. And for someone to not benefit from the tax relief is a mistake. And some people roll assets and support into one collective number without probably taking into account the tax implications, which could be a big mistake. And one of the best ways that we settle cases is when we actually share with the client, particularly the payor, that it doesn't cost them as much to pay that amount because they get to deduct it. But if we don't give them the deduction because we rolled it into another number or we didn't take it into account, it actually is like throwing money in the toilet for them. And it's a lot harder to settle a case.
Yeah, these are really important issues because in some cases, the tax consequences can be a significant amount of money. And so, when we as family law lawyers are advising our clients, if something is missed that has a tax consequence and it isn't brought to the client's attention, that can really be a problem for them down the road. And so it's very important. I know I think, Steve, you may have a more sophisticated understanding of some of the tax implications just because of files that you've worked on. And I am still learning some of the more sophisticated files. But I know if I have a file where I think it's warranted, I will bring in an advisor on the file, someone who's an accountant or a certified financial analyst, divorce financial analyst, or somebody who understands taxation, as an expert essentially, who can advise on those things. So if I have a client who has a significant amount of if there's significant property and assets involved and transferring things there are going to be tax implications, I want to make sure that I have that advisor as part of the team to ensure that my client is getting the best possible settlement if we are in fact settling it. What are some of the types of things that you've seen, Steve, on some of your files that are a little bit more sophisticated in terms of the tax analysis?
Yeah, and in fact, that's a good way to leap into just a bunch of examples, really. And I'm going to give you a bunch of examples. Let's just use the first example. The first example is the couple. They have a house and an RSP. They're both worth $1 million. Are they the same? Should one person get the RSP and the other one get the house? Absolutely not. Why? Because the $1 million home is worth $1 million after tax. The $1 million RSP might be worth $600,000 after tax. And yet they both look at the asset and they go, they're both $1 million. Without taking into account the taxes, they might make a mistake. One might end up with $400,000 more than the other, while on paper they thought they were being treated equally. What's another example? An RRSP worth $1 million and a pension worth $1 million. They might think, well, on paper, the pension's $1 million, the RSP is $1 million. That means each one gets one. No, because the RSP and the pension have different tax rates applicable to them because they are different asset classes. As a result of their asset class being different, the value at the date of separation, which is the date that we always study, is different. So the RSP might be worth, on $1 million RSP, it might be worth $600,000, whereas the pension worth $1 million on paper might be worth $750,000 after tax. What's a third example? A third example is when the assets are easy, but there's going to be a spousal support obligation. So let's use an example. Husband pays wife $2,000 a month, and the spousal support obligation in my example is 10 years. Well, 2,000 times 12 months is 24,000 times 10 years is $240,000. So if the husband says, well, look, we're selling the house, so rather than me paying you $2,000 a month for 10 years, I'll just, from my share, give you $240,000 and we'll call it a day. Big mistake. Why? Because under the Income Tax Act, the $240,000 is tax-free dollars to the wife and no deductibility to the husband. Number two, if the husband had paid the $2,000 a month over the 10 years, then assuming the husband was at the highest tax bracket, that would have only cost him $120,000. So by paying her the $120 plus another $120, which is $240 at the time of the closing of the sale of the home, which is closing right now, the husband's overpaid by $120,000. And more importantly, when you give somebody money today that isn't due for a while, there's a present value calculation. So, perfect example. If I can give you $1 a day for the next year or $250 right now, most people would say, you know what? 365, $1 a day, 250 right now. I'll take the 250 right now. You know, the old saying, a bird in the hand is better than two in the bush. But the present value calculation has a lot to do, by the way, with interest rates, determines the present value of money that would otherwise be paid over the period of time going forward. So those are some examples where clients of ours were really bewildered about how tax very much informs divorce settlements, and the failure to account for the implications of tax also could be a huge failure on the part of the advisor if they don't at least do what you do, Leanne, which is refer them to an accountant or a tax specialist so that they can vet the divorce settlement terms with their accountant to make sure that they've taken advantage of all of the tax implications.
Yeah, absolutely. And it's interesting because I think a lot of clients think that this stuff should just be very black and white. And it's not black and white usually at all. It can be very gray. And just by way of an example, I had a client last year who had a very large pension that was going to have to be equalized. And the big area of dispute between myself and the opposing counsel was what is the notional tax rate that we're going to use on it. And my client thought, well, it should just, why is there argument about that? Why isn't it just a specific rate and it should be black and white? But it wasn't an issue that was black and white. And there was quite a bit of negotiation back and forth on what the agreed rate was going to be. And because it was a large pension, that meant a significant amount of money in tax was going to be paid on it, and that needed to be factored into what was owed on the equalization. So the client, it was very educational for him to learn that this, like many things in law, I think a lot of people think it should be black and white, but it's not. There's a lot of gray, and it's not like we have general rules of thumb, and we get guidelines from actuaries and people like that. That's what I was using for what tax rate to use, and you can actually have an expert in that area even look at it and give you a tax rate if a client wants to pay someone to do that. But these can be complex, calculations, and it can be something that people end up having to spend a lot of money on their lawyers, even going back and forth. But if there's a lot of money involved, it's worth paying the money to get it done properly.
Yeah, and it's exactly right, because next to bankruptcy, divorce is a mammoth shakeup to one's personal net worth. And divorce covers all asset classes and income. In other words, there's no part of a person's financial life that is not shaken by divorce. Mm-hmm. And the government of Canada has very little mercy on people going through divorce, because the government needs tax revenue to provide services. So the government sees divorce potentially as a tax revenue opportunity, but for the exceptions that they have provided under the Income Tax Act. I'll give you another example. People, for example, think that child support and spousal support have the same tax treatment. Not true. Spousal support, so long as it's paid periodically, whether it's weekly, monthly, or biweekly, and in an agreement, is deductible to the payer and taxable to the recipient. Not the same with child support. Child support is paid on the gross pre-tax income with after-tax dollars. Let me make that very clear. If you earn $100,000 a year, You might bring home $70,000 a year after tax, but you're paying child support on 100 from the 70. And a lot of people don't recognize that there is a differential tax treatment for spousal support and child support. And up until about 25 years ago, child support was taxable and deductible until it was changed by law.
And why was it changed? What's the rationale? Do you know what the policy reason is for having the different treatment?
There was a appeal by a woman in the 90s claiming that it was unfair and oppressive for child support, that is money supposed to be paid to care for a child, to be treated the same as income, and therefore cause the recipient of child support to have to pay tax on it as though it was the same as them earning an employment income.
That makes sense.
The same argument wasn't brought forth for spousal support, quite frankly, because spousal support, if you think about it, is support of a spouse, which is supposed to replace them earning an income. Well, if it replaces something that's taxable, therefore the argument goes, it should be taxable. Whereas child support is a redistribution of money in the household to feed, clothe, and house children. Now, there's no shortage of people that will debate me or debate the government on the distinction and the dichotomy. But for us in practice, we just have to know it, and we have to know how to navigate it until such time that changes. But having said that, the government of Canada left a few goodies in the tax loot bag for payors. What are some of the goodies when it comes to child support? Well, there's at least two. Let me tell you what they are. Number one, if a parent or parents have childcare responsibilities and they have to arrange daycare or a nanny or a babysitter, if a family incurs caregiving costs for minor children, the government of Canada allows special treatment for the child care expenses and allows tax credits for those expenses. Or to put it in simple language, $100 of daycare does not cost the family $100 after tax because of the preferential tax treatment of that expense. That $100 childcare bill might only cost the family $60. If the $100 is paid by the mother, and the mother therefore gets tax relief for the $100 of childcare, then the father doesn't pay his share of $100. He pays his share of $60. Now, some might say, well, hold on. If the mother is paying the daycare today of $100, when does she get this tax relief? The answer is when she files her taxes next April, which means that tax relief may not be available to the mother until later, while the father is paying a reduced amount today. So that's the other side of the lack of tax relief for the payer on the full amount of child support, whereby there's a carve out for childcare. The other one is anybody going through a divorce who incurs legal fees or expert fees dealing with support. If the recipient incurred any legal fees or expert fees on the subject of support, then those fees are deductible in the year in which they paid it. The same does not apply for lawyer fees or expert fees for parenting or property. and it doesn't apply to the person paying support. And the idea behind it is the person that paid the legal and the expert fees had to pay it in order to collect. And since they are taxed, at least on spousal support, they should be able to deduct their expenses. Some say that's excellent. Others say that's unfair to the support payor. And why not give everybody tax relief, including on the subject of parenting and property division? But no, the government gave just that benefit to the recipient only on support issues. And so therefore, divorce lawyers like us regularly write letters, usually after the case is closed, to our clients so that they could include it in their tax filing in order to prove that they paid a certain sum of money for the collection of support so that they get to deduct it against their income.
And that can be quite a good break for people in that situation, because sometimes if you've paid, tens of thousands of dollars or more potentially in legal fees to do with support, and you can deduct that can make a big difference. And so I know this time of year, often clients are reaching out to their lawyers about those letters because it is helpful. I can understand from the support payors side how that might be frustrating, particularly in a situation involving spousal support where, perhaps the recipient maybe didn't have a very strong claim. And so the payor was fighting it or opposed to it. And it was, being litigated because it was a very weak claim. And yet still the recipient would be in the situation of being able to deduct legal fees, and the payor would not, even on a very weak claim.
Oh, listen, I'm not a tax lawyer. And quite frankly, I think I wouldn't do very well in tax law because it's very academic and very dry. But tax law is very much informed by social norms and policy. And we've today touched on some of the reasons for tax policy. And I could only imagine that any one of those tax policies was the subject of debate by various groups, maybe within the government or outside of the government. But yes, the interplay between divorce and tax is a live subject. It's complex. It's complicated, and it very much has a big part of divorce settlements. And anybody that's going through this should absolutely turn their mind to getting proper advice, whether from a lawyer who's experienced in the field or tax advisors or accountants who can guide them on it.
Absolutely. Thanks, everyone, for joining us. We'll be back again next week with another episode of Divorce Explained.